Welcome to the EDR Brief. Today we're cracking open the Q1 2026 10Q from Eaton Corporation, ticker symbol ETN, and translating it into plain English.
And I want to kick things off by dropping a massive number right up front. $22.8 billion.
Now, you might be wondering, if the global economy hit a brick wall tomorrow and Eaton's sales team suddenly couldn't close a single new deal, how long could the company survive? Well, the answer lies in that $22.8 billion figure. That's their backlog. It's a financial safety net so massive, it makes Eaton virtually bulletproof against a sudden economic halt.
But before we explain exactly how they built that armor, a quick note. We are an independent channel, not affiliated with the SEC, and we're definitely not your financial advisors. We use AI to help summarize these massive filings so errors can happen. Always verify the numbers on sec.gov before making any money decisions. This explainer is a translation, not a recommendation. All right, let's get into it.
So, how does an over 100-year-old industrial company actually make its money today? To really understand Eaton, you have to understand the classic picks and shovels framework. You know the old saying, during a gold rush, the folks digging for gold take all the risk. But the folks selling the picks and shovels, they make guaranteed money.
And that is exactly how Eaton operates. Think of the modern economy as a human body. Eaton does not build the brain, like a massive AI data center, and they don't build the muscles, like a commercial airplane. Instead, Eaton builds the circulatory system. They sell the electrical wiring, the power enclosures, the hydraulic pumps, and the thermal cooling systems. Basically, whenever electricity or fluid needs to move safely and efficiently from point A to point B, Eaton builds the pipes and the switches to make it happen. They collect a toll on massive megatrends, like electrification, without taking on the risk of actually building those giant end products.
Which brings us right back to our hook. Because Eaton is the circulatory system for so many critical industries, their customers have to order these parts well in advance. And that is what backlog means. It's simply future money already in the bank. Orders placed by customers that haven't been shipped or billed yet. At $22.8 billion, and with roughly 68% of that targeted for delivery in the next 12 months, that is guaranteed cash flow just waiting in the wings.
But they aren't just coasting. The company is actively changing shape. In this filing, Eaton announced they're essentially kicking their legacy mobility business out of the house. By the end of Q1 2027, the mobility segment, which makes transmissions and engine valves for vehicles, will be spun off into its own independent, publicly traded company. They're trimming the fat to focus purely on the explosive growth in their electrical and aerospace divisions.
Let's see how all this translates into their actual Q1 2026 scorecard. We always look for the numbers that actually matter, and quite frankly, this quarter presents a really fascinating accounting paradox.
Just look at the glaring discrepancy here. Revenue is absolutely surging. More dollars are walking in the door, jumping 17% from $6.3 billion last year to over $7.4 billion this quarter. And operating cash flow, the actual hard cash generated by the business, skyrocketed 113% from $238 million to $507 million. But net income, the bottom line accounting profit, it actually dropped from $964 million down to $866 million.
So you gotta ask, how do you make way more sales, generate double the raw cash, but somehow report a lower profit? This brings us to a golden rule here on the EDGAR brief. Cash flow beats accounting profit when they disagree. Profit can be fiction, easily manipulated by accountants, but cash in the bank, that is a hard fact.
The reason profit dropped is largely due to an accounting ghost called intangible asset amortization. Look, when a company buys another company, accountants force them to take a paper penalty against their profits over time. It is not real cash leaving the building today. In Q1, Eaton took a $140 million hit for this, up significantly from last year, which artificially dragged down that net income number.
If you want to know where the real money is being made right now, just look at the segment breakdown. Electrical Americas is the absolute powerhouse, pulling in $922 million in operating profit alone. They are riding that massive wave of data center expansion and grid infrastructure upgrades. Aerospace is holding its own at $304 million, while that soon-to-be spun-off mobility segment sits way down at just $89 million.
Now, why did Eaton have such a massive jump in those accounting penalties we just talked about? Well, because in the first quarter of 2026, Eaton went on an absolute mega shopping spree to build the future version of the company.
Let's walk through this timeline. In January, they bought an aerospace parts maker called Ultra PCS for $1.53 billion. Then in March, they bought a huge data center cooling company called Boyd Thermal for an eye-watering $9.55 billion. But here's the thing. Eaton didn't just have $11 billion lying around in the couch cushions. To pay for all this, they went to the bond market and issued $8.5 billion in U.S. debt and another $1.2 billion in euro debt. They borrowed a mountain of cash to immediately buy dominance in these key markets. And when you buy companies for $11 billion, you're almost always paying way more than the raw physical assets, the factories, the desks, the computers are actually worth. Accountants call the difference goodwill. Think of it like the tip left on the table. It's the premium Eaton paid for the brand name, the customer relationships, and the market position.
After this massive Q1 shopping spree, Eaton now has a staggering $21.4 billion of goodwill sitting on its balance sheet. That tells us management is making a highly aggressive bet that these new companies are going to generate massive future cash flows to justify the huge premium they just paid. Which naturally brings us to the risks. We always want to read between the lines of management's discussion and analysis to see the fine print and figure out what might actually threaten this aggressive growth story. The biggest red flag waving in this filing is a squeeze on their gross margin. This metric tells us for every dollar of revenue that comes in, how much is actually left over after paying for the raw materials to build the product. Last year, Eaton kept 38.4 cents on the dollar. This quarter, that shrank to 35.6 cents.
And to their credit, management is very straightforward about why. Direct quote from the filing here, a 400 basis point decline from commodity and wage inflation. Translation? Everything costs more to build, and employees cost more to keep. So even though they are selling more products than ever, it's costing them significantly more to produce those products, which just eats straight into their underlying profitability.
So let's do our moat check. Eaton's moat is undeniably massive. They have unmatched scale in critical infrastructure. Think about it. Once an Eaton electrical panel is wired into a hospital or a data center, the switching costs are incredibly high. Nobody is ripping that out just to save a few bucks. But the risks are very real right now. They have to smoothly integrate $11 billion worth of new companies. They have a massive new debt load to service, with interest expense jumping from $33 million to $106 million this quarter alone, and they're fighting a daily war against commodity inflation. All right, let's bring this all together. What's the final verdict on Eaton Corporation after digging through this 10Q? Look, Eaton is a cash cow industrial giant that is aggressively reshaping itself to ride the electrification and data center megatrends. They are literally trading in their legacy automotive parts for high-margin power and cooling systems. When the Q2 filing drops, here are the 3 specific things you need to track to see if the strategy is working. Number 1, watch that operating cash flow. We want to see hard cash continuing to outpace that accounting net income. Number 2, watch the gross margins. Can Eaton raise prices fast enough to beat back commodity inflation, or will margins keep shrinking? And number 3, look for any updates or potential delays on spinning off that mobility segment by 2027. I'll leave you with this final thought to chew on. Eaton just made an $11 billion bet on the future of the electrical grid and data centers. Will that aggressive expansion outpace the crush of commodity inflation and the heavy anchor of their new debt? That is the billion-dollar question. That wraps up your EDGAR brief on Eaton Corporation. Remember, this was a translation, not a recommendation. Go read the original filing on sec.gov if anything piqued your interest. Thanks for being with us today, and I'll see you in the next explainer.